1. Traditional view, volatility in finance. In classical financial theory, e.g., modern portfolio theory, risk is measured by volatility, typically using standard deviation or beta to quantify how much returns fluctuate around an average. This view assumes that variability of returns represents uncertainty and, therefore, risk. However, this is a modeling convenience, not a complete definition of risk. 2. Why volatility is not equal to risk. 2.1 Volatility measures movement, not loss. Volatility simply describes how much an asset's price moves up and down. It penalizes both upside and downside fluctuations equally, which may be inappropriate because investors generally care more about losses than gains. An investment can be highly volatile yet still earn strong returns over time. Conversely, small volatility doesn't guarantee safety if the investment permanently loses value. 3. Academic critiques of volatility as risk. 3.1 Statistical and theoretical limitations. Recent research argues traditional volatility measures rely on restrictive assumptions that fail to capture true risk. Volatility is path-independent, ignoring temporal patterns in returns that may indicate real vulnerability. It assumes stationary processes, which are often invalid in real markets. 3.2 New proposed frameworks. Some papers propose alternative mathematical tools that focus on predictability and inefficiency instead of pure variation. Frameworks using Hurst-Holder exponents aim to quantify risk in terms of structural patterns in prices, not just dispersion. 4. What true risk entails beyond volatility. 4.1 Permanent loss of capital. Risk is better defined as the chance of not achieving financial goals or suffering permanent loss, e.g., bankruptcy, leverage blowups. Temporary price movements do not necessarily affect long-term wealth if the underlying asset remains fundamentally sound. 4.2 Tail risks. Rare but extreme events, not captured by standard deviation, can devastate portfolios. This is called tail risk, which describes the probability of large adverse outcomes beyond the normal distribution. 4.3 Liquidity risk. Even if a price doesn't fluctuate wildly, you may be unable to sell an asset quickly at a fair value. High volatility can sometimes enhance liquidity. Illiquidity often represents real risk. 4.4 Behavioral and psychological risk. Investor behavior, fear, panic selling, herd effects, affects outcomes more than price volatility itself. Tools that measure volatility don't account for behavioral responses that can turn temporary dips into realized losses. 5. Practical implications. 5.1 Misleading risk questionnaires. Standard risk tolerance questionnaires often equate discomfort with volatility to risk. In reality, true risk management should focus on outcomes, like whether a portfolio can sustain financial life events or meet long-term goals. 5.2 Portfolio management. Focusing only on volatility can lead to overly conservative portfolios that lag inflation, misallocation of capital based on short-term price movements instead of long-term strategy. A broader approach includes scenario analysis, stress testing, and drawdown measures. 6. Risk categories beyond volatility. Risk in finance includes multiple dimensions beyond price movement. Market risk. Risk of losses from market movements, but not just volatility. Credit risk. Risk of counterparty default. Liquidity risk. Risk of inability to sell at fair price. Operational risk. Risk from internal failures, systems, people, processes. Systemic risk. Risk of collapse affecting entire markets or institutions. 7. Conclusion. Volatility is a useful statistical concept, but it is not synonymous with risk. True risk encompasses permanent capital loss, failure to meet objectives, liquidity constraints, tail events, and psychological effects. Finance needs a richer set of metrics, e.g., drawdowns, tail risk, scenario analysis, to truly measure and manage risk.